And now introducing Mr. Keith Lanton.
Good morning. Welcome to Monday morning, October 10th, second Monday of October. Today is Columbus Day, also known as Indigenous People Day. So bond market in the United States is closed today, as are many federal offices. The stock market is open all day, and we have a lot of information to discuss this morning, both in terms of events that took place last week and what we have to look forward to this week, including many different earnings reports and some key data that we will receive with respect to inflation and earnings this week, which will give us a lot more insight into where the Federal Reserve might be going, which is, in my opinion, the primary driver of financial markets here in the United States and throughout the world. With the bond market closed today, we do have Brad with us, which we appreciate Brad being in this morning, and he will share his insights this morning. First thing I'm going to do this morning is just step back and share some thoughts from James Clear. I've shared his thoughts many times previously, and thought that he had some great insights in his last letter, and wanted to share them this morning to get us in the frame of mind for perspective as we often get lost in the details of the week. Like to start out by trying to pull us all the way back and to think holistically, and then we'll dive into the details. So on listening, learning, and reflecting, as Ray Dalio would say, James Clear said, "Keep ignoring feedback, and life will keep teaching you the same lesson." And one of the advantages that we have as we get older and we have a lot more autonomy is we can choose the game that we wish to participate in. We can choose the career path that we are interested in. We can choose whom we spend our time with, whom we choose to spend many portions of our life with. We can choose where we work, what our career is. And on that score, James Clear said, in sports, and that's once you're involved in the game, one of the primary sources of advantage is you get to choose how to play the game. But even better in life, one of the primary sources of advantages is choosing which games to play. And when we do participate in different aspects of our lives, we encumber many challenges as we strive for success. And on that he says, the brilliance of the stars would be invisible without the vast darkness of space behind them. What does he mean by that? He means, do not wish away the difficult portions of life. They provide the contrast needed to appreciate the joyful moments. And then some quotes from some others on his weekly blog. The poet Annie Dillard, on the value of a schedule, said, how we spend our days is, of course, how we spend our lives. What we do with this hour and that one is what we are doing. A schedule defends from chaos and whim. It is a net for catching days. On a different subject, Charlie Munger, Warren Buffett's partner on intellectual humility, said, a lot of smart people think that they're way smarter than they are, and therefore they do worse than dumb people. And it's very common to be utterly brilliant and think you're way the hell smarter than you actually are. And as you go through your week this week, think about what is the most important to you as you confront challenges with business partners or spouses or children. Think about cost benefits. So the benefits that arise from a good relationship, whether it be in a marriage, friendship, business, or otherwise, are often produced over a long time span. So think about, is it more important to win this battle that you have in front of you right now, or is it more important to maintain the relationship with whomever it is that you are battling? So with those thoughts behind us, we'll delve into the details of the day and the morning. We'll get started with taking a look at where we are in financial markets and what we have to look forward to this week. On Friday last week, it got lots of attention, but perhaps not the attention it deserved. The United States and the Biden administration issued a bunch of sweeping export rules aimed squarely at the Chinese economy and the Chinese military, whereby we here in the United States set aside a sweeping set of export controls, including a measure to cut China off from certain semiconductor chips made anywhere in the world with U.S. equipment, vastly expanding the reach of the United States and previous declarations on chip technology in the U.S.'s bid to slow Beijing's technological and military advances. And the Chinese often react slowly after they have time to digest news, and we'll see if there's a reaction to these more sweeping changes coming out of Washington as a result. This morning, we are seeing futures backing off from modest losses, although still fairly modest. The Dow futures are down 16, S&P futures down 6, NASDAQ futures are down 34. Equity futures indicate a lower open thanks to a negative carryover momentum from Friday's retreat. However, they are off their overnight lows. There is some hesitation ahead of the Federal Open Market Committee meeting minutes from the September meeting, which come out on Wednesday. New inflation data, PPIs Wednesday, CPIs Thursday, and earnings reports from major financial institutions on Friday. The Bank of England announced additional measures to support market functioning ahead of and following the expiration of its gilt purchases on October 14th. That's when they're going to wind down the emergency action that they took to prop up the pound. Reports this morning indicate that COVID cases are rebounding in China, pressuring stocks with high exposure to that market. And Russia has stepped up its missile attacks on the Ukraine following the Crimea bridge blast over the weekend. Vladimir Putin calling it a terrorist attack, and the Russians are using more of their high-tech cruise missiles. They seem to be holding back from using them, perhaps out of concerns that they were running low in supply, but pulling them out of their stock to fire them at Ukrainian cities with some deadly accuracy, reports this morning. Energy complex futures are mixed. West Texas Intermediate is down about 39 cents, about 0.5%. Gas futures are up, natural gas futures, that is, are up about 0.5% this morning. In other news this morning, Bloomberg is reporting that Fed officials want to raise rates to 4.5% and hold them there. That's an interesting report for them to so boldly state something such a clear policy. Perhaps getting some guidance from Federal Reserve officials, and we'll talk about that 4.5% rate and some commentary from Barron's. Reports in the Wall Street Journal that Paris is shutting down electricity at various monuments to save energy. Financial Times reporting that Treasury Secretary Yellen in an interview says OPEC production cuts are bad for the global economy. And the Financial Times is reporting they expect the banks to set aside about $4 billion for bad loans in this upcoming quarter. That is one of the metrics that markets will be keying on this week as we get some of the larger banks reporting earnings, and a lot of attention will be on what they think in terms of loan loss provisions. Some companies in the news this week, Kraft Heinz, symbol KHC, which has dropped about 20% in the last few weeks, was upgraded to buy from neutral at Goldman Sachs. Procter & Gamble, symbol Paul Golf, PG, downgraded to neutral from buy at Goldman. Ford was downgraded to sell from neutral at UBS. And General Motors was downgraded to neutral from buy at UBS. Merck this morning picking up, announcing positive top-line results from a pivotal Phase 3 drug study evaluating a drug for the treatment of adults with pulmonary arterial hypertension. As a result, Merck was upgraded to buy from neutral at Guggenheim, and the stock's up about 2.5% this morning. Rivian, symbol RIVN, electric vehicle maker aiming to compete with Tesla, said that they are recalling nearly all of their vehicles due to a steering issue. That's according to the Wall Street Journal. Stocks down about 8% on that news. And casino stocks with exposure to China are lower. Las Vegas Sands, for example, down about 3% on reports that COVID cases are rebounding in China. So looking forward to this week. I mentioned already that the bond market is closed today. We start getting potentially market-moving data on Wednesday when Pepsi releases its third quarter results. Also on Wednesday, we talked about the Fed releasing its minutes from its late September policy meeting where they raised rates 75 basis points. Also on Wednesday, the PPI will be released. Economists forecast the PPI will jump 8.4% year over year after an 8.7% increase in August. So looking for it to moderate but still stay very elevated. That is the Producer Price Index. Then on Thursday, lots of attention will be focused on the BLS releasing the Consumer Price Index for September. Consumer prices are expected to show a year-over-year increase of 8.1% for the main rate and a 6.5% rate for the core. That is relative to August when we saw 8.3% for the headline number and 6.3% for the core. Thursday also we'll see some earnings from BlackRock, Delta Airlines, Domino's Pizza, and Walgreens Boots Alliance. Friday, big banks unofficially kick off crucial third quarter earnings season. Citigroup, JP Morgan, Morgan Stanley, Wells Fargo, First Republic Bank, PNC Bank, and U.S. Bank Corp. all reporting earnings on Friday. Also on Friday, University of Michigan releases consumer sentiment survey for October. That's expected to come in at 57.5, down a point from the previous month. And then on Friday, we also get reports on spending for September. Economists forecast that retail sales will increase 0.2% month over month. That's down 0.1% from the previous month. And those retail sales are expected to be flat if you factor out auto sales. So moving on to Barron's, talk about the markets last week and what may take place this week. First article that I will mention is the Trader column. The stock market fought the Fed and paid the price. Don't count your chickens, they say, at least not until they're hatched. That's something the stock market keeps forgetting every time it rallies into a Federal Reserve pivot that appears to still be a long way from happening. From the early part of last week, a bad news is good news mentality ruled as each disappointment was greeted with a surge in equity prices. We saw a data showing that we had softer manufacturing and even more positively, at least so the market thought, was a sharp decline in job openings. That led to a 5.7% jump in the S&P 500 on Monday and Tuesday of last week, the biggest two-day gain since April of 2020, when the stock market was in its early innings of a COVID rebound. And why not? A weaker economy and a slowing job market could have meant that we were going to see slower inflation and therefore less Fed rate hikes. However, things changed quickly. It all went downhill starting on Wednesday, as we got some hawkish comments from Fed officials. Then we got stronger services data. And then Friday's jobs report drove home the point that we're still a ways away from an economy or a labor market that justifies the end of tightening. The S&P 500 slid 4% from its Tuesday peak, still finished up about 1.5% for the week. The Dow finished up 2% for the week, and the Nasdaq finished up about 0.75% for the week. But a lot of the gains that were enjoyed earlier in the week were forfeited. Bank of America strategist Mark Cabana said no one should be surprised. Investors may hope for a policy pivot, but hope is not a strategy. The U.S. economy wound up adding 263,000 jobs in September. The unemployment rate sank back down to 3.5%, the government data showed on Friday. Granted, the pace of hiring slowed from 315,000 in August and 537,000 in July. But with gains still piling up, markets are rethinking that this is not enough to convince the Fed that the labor market has softened enough, especially when the unemployment rate came in at 3.5%, which is a half-century low. So another 0.75% interest rate hike remains the base case for the Fed's November meeting, which would take the upper bound of the committee's target range to 4%. As a result, what are investors doing? Well, plenty of investors appear to be hoarding cash in anticipation of better buying opportunities ahead, or at least waiting for calmer waters. Inflows to cash funds totaled $88 billion during the week ending October 5th. That's the highest since COVID, April of 2020. Bonds saw outflows of $18 billion. Stocks shed $3 billion. If you're looking for a silver lining, someday all of that cash will probably be put back to use and find their way back into financial markets. But when that day is to come is, of course, the big mystery. So, last week, at the beginning of the week, we sort of were thinking that bad news was actually good news. We got a slew of bad news, and we also had concerns that Credit Suisse might be under some financial distress, and concerns that the Federal Reserve didn't want to contribute to pushing a large financial institution over the edge. That bad news was also viewed as good news, and markets reassessed that thinking, reassessed their feelings on whether the Federal Reserve would be concerned about Credit Suisse, so much so that it would pose a risk to the system, and ultimately decided that the bad news that was seen earlier in the week was not enough to diminish the Fed from hiking those interest rates, as we just discussed. And earlier in the week, the probability that the Fed would raise by 50 basis points instead of 75 basis points was at about a 50% probability. By the end of the week, the odds heavily favored a 75 basis point hike at the next Fed meeting, which is November 1 and November 2. Perhaps even more importantly, there was a shift in tone for the following Fed meeting, which is December 13th to 14th. Many had anticipated a 25 basis point increase at the beginning of the week. That was repriced to an expectation of 50 basis points later in the week. And some even suggesting the Fed could now go 75 basis points at that December meeting. Given the Federal Reserve commentary, and given that Bloomberg article this morning about that 4.5% rate, that might be more indicative of 75 at the November meeting, 50 at the December meeting, and perhaps the Fed waiting and assessing at that juncture. Last week, we also had reports from OPEC that they were cutting oil production, resulting in oil prices spiking 13%. And we got an earnings warning from Advanced Micro Devices, AMD, which pressured technology stocks as well. All of that contributing to the market sinking as the week went on. If you're looking for a silver lining to the destruction that's taken place, especially in the equity markets, but as Brad will tell you, there's been a lot of carnage in the bond market as well. The silver lining is that even though taxes aren't due for more than 6 months, it's time to start thinking very heavily about the tax loss selling. That's the term for selling a stock at a loss and using that to offset gains elsewhere within one's portfolio. With only 18% of U.S. equities positive year to date, there'll be plenty of losing stocks to choose from. Perhaps you're an investor who sold a little bit earlier in the year when stocks were still making highs, and now you have an opportunity to offset those gains with perhaps some losses in your portfolio. But even if you weren't fortunate enough to take gains early in the year, investors can take losses up to $3,000 and reduce their ordinary income by $3,000, which is a strategy that may make sense. If you're looking a little bit further out in the rest of this year, typically tax loss selling takes place in November through mid-December, and then many of the companies that were subject to that tax loss selling pressure start to rebound. Some other strategists suggest taking a look at tax loss selling now in October because many hedge funds and mutual funds have year ends that are either 9/30 or 10/31. They're big players in the markets. They take their losses either 9/30 or 10/31. And then in many cases, they may start reaccumulating some of the stocks that they sold, thereby presenting bounce candidates for some of the biggest losers of the year. Some of the big institutional holdings that some are suggesting were subject to tax loss selling that may be worth a watch later in the year are Disney, DIS, Domino's Pizza, DPZ, NVIDIA, NVDA, Meta, META, and AMD. Either way, most of the selling should be done by mid-December, at which time it may be time for the losers to begin to shine once again. One of the sectors of the economy that's being most affected by rising rates is the housing market, and this effect has happened with a lag because most buyers of homes don't close on their homes for 3 to 6 months after they've agreed to make a purchase. So we're really starting to see the effects of rising rates trickle into the economy and into the housing market right now. And what's happened is, as a result of rising interest rates, the average increase in cost for a home has crept up about 80% in terms of a monthly mortgage payment. So just to put this in perspective, if you had a $450,000 loan a few months ago, and that loan was at 3%, you had a monthly mortgage payment of $1,900. If $1,900 is what you could afford to pay per month for your mortgage payment, that payment in this current environment would be taking place with a 6.5% interest rate, and that would mean that instead of buying a home for $450,000, you could buy a home for 1/3 less, or $300,000. No wonder the bidding wars of 2021 have given way to a sharp slowdown in home buying and resulting in softness in home prices. But as I just mentioned, the impact is just beginning to be felt. Fed rate hikes hit the bond market first, then the stock market, and now we are seeing the housing market, given the lag time it takes for housing to feel the pain of rising rates. Another thing that's different this time is in past cycles when mortgage rates have spiked, the government-sponsored enterprises, Fannie Mae and Freddie Mac, have been active buyers of buying back their own mortgage-backed securities, often at a discount when interest rates have risen, and taking them out of circulation. But at the same time, what that does is it starts compressing the spread of mortgage rates to treasuries because you have an active buyer of mortgage-backed security paper. That doesn't happen anymore. So one of the offset when you start seeing higher rates to bring those rates back down has been removed from the marketplace, and therefore the rates this time on mortgage-backed securities relative to treasuries are higher than they have historically been, and we are not getting that compression pressure that we've seen in past cycles. The cover story of Barron's talked about the super strong U.S. dollar and ways to invest abroad. The dollar this year is up about 17% against the basket of the largest currencies, and it's close to its strongest level in decades. What's interesting is if you look at the dollar versus the economies that we most heavily trade with, countries like Mexico and Canada, and then many of our European and Chinese counterparts, when you look at it from that perspective, the dollar is still up significantly, but not quite 17%, but 11% when weighted against our trade-weighted partners. Nevertheless, we're seeing extremely strong dollar, and what that means is that many of the S&P 500 companies that do business overseas are expatriating back that foreign currency into less dollars because those currencies are worth less. And we will see what sort of impact that is going to have on earnings as we start seeing these third quarter earnings roll in. For some perspective, the dollar is up 15% year to date against the euro, 20% against the pound sterling, and 25% against the yen. What does that mean going forward? Well, Barron's is suggesting that when you see the dollar up as much as it is versus these foreign currencies, oftentimes it means that we are getting near a cyclical peak, and that historically, when the dollar has appreciated as much as it has versus many of the countries that the United States trades with, that it's often a good time to look overseas at foreign investments and foreign stocks, because in many cases those stocks are out of favor, trading at significant discounts to earnings, and also being reflected back to us in currencies that are severely depreciated. So if there were to be a rebound in these overseas markets, you could potentially get a double benefit. One, the PE ratios in foreign countries could expand, thereby enhancing the stock price through multiple expansion. And secondarily, if those currencies were to begin to recoup some of the losses that they have experienced, when you translate those foreign stocks back into dollars, if those currencies are appreciating, U.S. investors would get the dual benefit of PE expansion and currency expansion, and see appreciation in their foreign investments. This is something that U.S. investors have not seen for quite some time. Investing overseas has been a portfolio drag for an extended period of time, and previous suggestions to invest overseas have certainly been premature. But now, once again, may be a good time to start thinking about overseas investments in terms of diversifying one's portfolio, given the fact that not only are these stocks cheap on a fundamental basis, but based on the fact that the currencies are depressed based on historic norms. One interesting fact before I turn things over to Brad is the oil company ExxonMobil, which does most of its business in dollars, is expected to clear more dollars this quarter than Google will in terms of cash flow. Someone had suggested that a couple of years ago that ExxonMobil, which was written off for near dead, fossil fuels were going the way of the dodo bird, and someone were to suggest to you that in a year or two that ExxonMobil was going to out cash flow Google in just a few quarters, you probably would have suggested that that person was the irrational one, and that that was a very unlikely scenario, and yet here we are. So that once again proves that the challenges of investing, the challenges of trying to outsmart the market, the importances of diversification, and the importance of being humble as we all approach our investments. With that, I'll turn it over to Brad. Good morning, Brad.
Morning, Keith. Good morning, everyone. In New York, it was a beautiful weekend, and we had a rare weekend where both the Jets and Giants football teams won their games. Unfortunately, the Mets could not pull it out, but the Yankees are still in the hunt. Besides from being a sports fan, I care about things like this because personally and as a company, we and our clients own a lot of New York municipal bonds, New York real estate, and other commitments to New York beyond that, many that we're not even aware of. Having activity and positive news coming out of the New York area is very important for our city and our state's reputation and our economy. And that's why, even though I may have my favorite teams, when the New York team is moving forward in the playoff hunt, I will always root for the New York team. So that's just a little personal aside of silly things that I think about over the weekend with relationship to the business that I do. The Treasury bond market is closed today, but as of Friday, we closed with an even steeper inverted yield curve. The 2 years closed at 4.31%, the 5-year at 4.14%, the 10-year at 3.88%, and the 30-year at 3.84%. It is very possible this inversion even gets more extreme. Historically, smart institutional money buys longer bonds in these scenarios with the understanding that this curve is the signal for recession and that ultimately, at some point, the Fed will have gone too far, damaged the economy, and will have to reverse course back to lower rates. That's why the institutions feel that at a point like this, they may want to lock in longer rates. I prefer not to overthink what institutions do. It's good to know what they're doing, but it's important to stay your course. Buy the best available bond. I've had a tremendous amount of inquiry, as well as all bond traders and dealers. We've had tremendous amounts of inquiry and business this last month. Everything from T-bills to short-term corporates to municipals. Across the board, across the maturity spectrum. None of us know where these markets begin and end. It's an understatement, but they've been extremely difficult. Stay focused. I am comfortable that bonds are truly investable at these levels as a real part of a portfolio, whereas for years I couldn't say that with comfort. I would have to say this is the best house in the worst neighborhood, but now the bonds are not a bad house in and of themselves. I hope everyone has a great day. Pass it back to Keith. Thanks.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. This podcast is available on most platforms, including Apple Podcasts, Spotify, and Pandora. For more information, please visit our website at www.heroldlantern.com.
Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.